Hello and welcome to the weekly wrap-up. Joining me to discuss the market movers is Andrew Johnston, Deputy Chief Dealer with One Financial Markets. So, Andrew, first up today we have just seen the data release of the US Non Farm Payrolls, which came in significantly below many forecasts at 126,000 extra jobs. This was a massive shock in comparison to 295,000 jobs for February. But is it really as bad as it seems?
The 126 figure, I think Janet Yellen is going to be absolutely having a party. This is exactly the figure she required to keep the status quo as it is. The central bank has been downgrading economic growth and inflation in-house, since a couple of years, and this figure means that she can keep zero rates, or effectively zero rates, for potentially until next year. There was talk if it was going to be a bit healthier around the 250 mark, then we'd look at June, maybe September. But this has really played into our hands, and perhaps she'll be having a bit of a party tonight.
Moreover, US non-farm payrolls usually has a significant impact on the US dollar too, which is evident in its apparent collapse at the moment. But is this a knee-jerk reaction or the beginning of the end of the dollar strength story?
Yeah, most definitely. I mean, liquidity today as well. I don't know what the BLS were thinking of putting non-farm payroll on Easter Friday. Liquidity poor. We saw 100 pip moves in euro dollar and dollar yen. S&P off. Dollar index off as well. I mean, it was just pretty much carnage, to be honest. But I think there's lots of traders just not in today. I know many of the investment banks have skeleton crews on. The big effect will come on the Tuesday. We do have a Sunday open in FX when gold will open as well. So I do suspect we'll have a very nice little gap in gold in the Sunday open. But it was the liquidity out there is incredibly poor. But as you say, I think it will be a knee-jerk reaction. It's dollar off, okay, but then this just means that rates stay at zero for the foreseeable. Free money for all these investment banks. There's no yield out here. 10-year bonds are trading at 1.9% yield. Unemployment rate still 5.5%. Stuff isn't really going along. So what you're going to do? Stick it back in equities, and that's what's going to happen, really.
Lastly for today, what is it in particular that you will be keeping your eye on over the next trading week?
I think it's going to be, because we have Monday off as well, Tuesday will be very interesting. What I have been looking at as one of my active indicators is Baker Hughes rig count, which it shows the active rigs in operation in the US. That has been dropped by 48% since end of 2014. And obviously oil is a bit of a major issue in the States. Perhaps some of that is the shale, but that gets released on the day after, on the Thursday. So if the rig count's down again, that obviously affects not just drilling, but it affects suppliers and obviously families around the area. If you've got manufacturers, wholesalers, bars, restaurants, all that. If the rig count's going down, that means there's no people working, and no people working means no people are buying anything. Also, I'm looking at the Baltic Dry Index at the moment, which measures the transportation costs of raw materials across the world. That's trading at 588 at the moment, which is on par with 2009 when we had the financial market collapse. So all these indicators, which I think are true definitions of what's really going on in the world, show that manufacturing and job creation is pretty low at the moment.
Thank you, Andrew. For more updates and to see how the markets are shaping up next week, join Jess Walker for the week ahead on Monday. Goodbye for now.